bankish and has had to deal with regulatory issues. Fred, welcome to the podcast. Thank you for joining us.
Thanks, Rudy. Great to be here.
So, Fred, the million-dollar question I have for you. Oh, and by the way, before they go on, I am doing this from a hotel room in New York City. So if anybody hears an ambulance, they're not coming from me. Okay. Fred, is our money safe? That's the million-dollar question people are asking.
Well, before I answer that, Rudy, I just want to say that I wish I could find a hotel room in New York like the one that you have. But the answer to your question is yes, but your money in a federally insured bank in the United States is safe. The question is, of course, what does safe mean? Because banking is really all about managing risk. And anybody who has money, of course, has to worry about whether or not they can hang on to it. You could decide that your bank was not safe and take your money out of the bank. And then you could put it under your bed or bury it in a milk can in your backyard. But then somebody could come along and steal it. So your money is never completely safe. And the banking system is an exercise in risk management. It's set up to minimize the risk to depositors, which is what we're talking about when we say our money is safe, while at the same time allowing bank investors, shareholders, to earn a reasonable rate of return on the money that they've invested in the bank. We could make banks much less risky if we forced them to simply accept deposits, keep them all in the vault, and give them back when we wanted them. But banks would never make any money that way, so no one would ever do it. So banking is an exercise in risk management. I thought it would be a good idea tonight to look at some recent bank failures that have been in the news, talk about what happened, and then talk about how things might have been different if they had managed risk differently. So with that, if it's okay with you, Rudy, I'm going to share my screen.
Go ahead, Fred.
So let's talk a little bit about how banks work. In the United States and also in most other countries, we have what's called a fractional reserve banking system. And what that means, and you can see this slide before, and some of you may be familiar with this, is that starting with the $100 starting on the right-hand side with the $100 that someone deposits in the bank keeps about 10% of it and then loans the other 90% out as a loan. Now somebody has a $100 bank deposit and somebody else has a $90 loan. And the borrower will then take that $90 and deposit it, maybe in the same bank or maybe in another bank. And then the bank will take that $90 and lend out 10%, and 10% is just a made-up figure, lend out 90% as a loan and keep the remaining 10% in the bank, et cetera, et cetera, et cetera. This is what leads some people to say that banking is a Ponzi scheme because the bank doesn't really have the money and is simply paying you back with money they get from other people. And while there's some truth in that, it's not true that banks actually are running a Ponzi scheme. Banks are actually operating in a way that they have since banks were invented about 500 or 600 years ago. But banks have also been failing for as long as banks have been operating. So it's important to understand how a bank is constituted today. And if we look at this, banks have assets, they have liabilities, and they also have equity. And it's important to get the terminology right because otherwise it can be very confusing. A bank's main assets are its loans. Banks make money by lending money. That's the main way they make money. Banks will also hold securities, stocks and bonds, as another way to make money. Then on the other side of the ledger, you have liabilities. The main liability of most banks is deposits. People have trouble sometimes conceptualizing that.
Yeah, they tend to think that they've got my money. It's not a liability, but it's subject to being withdrawn at any time.
Right. And all liability means is that you have a claim on the bank for your money. And typically, yes, in a deposit account, you can withdraw it at any time. There are also time deposits, a CD that you can buy for 3 or 4 years for a rate of interest. But most of what's been in the news lately have been what's known as demand deposits, payable on demand. And the reason banks take deposits is so they can lend out the money to other people, because that's how they make money. And that's why deposits are considered a funding source for banks. But banks have other ways of funding themselves in the capital markets. They can borrow short term from a lot of different places, from in the private markets, or from some federal agencies, which we'll discuss in a minute, or they can borrow long term. They can issue bonds, and then they have more money to lend out. But underlaying all this is the bank's equity, and that's really the most important thing, because banks today are required to have a certain amount of equity. In other words, money that nobody has a claim on, that is the shareholders' money that was put in the bank as an investment. And that takes the form of either subordinated debt, that is debt that is paid off only if all other creditors are paid off, hybrid debt, which looks a little like equity and a little like debt. They're also called additional tier one instruments. You may have heard that in the news lately. And finally, stock, which we're all familiar with. And that is what makes a bank, the equity that it has in reserve which allows it to operate, to make loans, and to take deposits. The other thing that's important to remember, and let me just go get out of the screen share here now, is that the other thing that everybody relies on in connection with banking today is that banking is a very heavily regulated industry. I mean, everybody knows that the Federal Reserve regulates banks. There are actually several other banking regulators in the United States, including the FDIC, the Federal Deposit Insurance Corporation, and the OCC, the Office of the Comptroller of the Currency. But they all do basically the same thing, which is they require banks to hold a certain amount of capital. For most banks, it's 8%. For larger banks, it can actually be much more than that. They also require banks to hold a certain percentage of liquid assets. So if somebody comes knocking on the door for their deposit, you can be sure the bank will have it. Regulators also enforce what are called safety and soundness regulations. They make sure that the bank is operating in a way that is prudent, isn't taking too many chances, and isn't overpaying its executives, among many other things. But banks are very closely supervised. Bank regulators also provide what's called a lender of last resort function. In other words, if the bank really needs the money because its loans are going bad or all its depositors want their money at once, it can go to the Federal Reserve and borrow. It's what's called the discount window, which is the place where banks borrow when they have when no one else will lend them. And then finally, of course, the regulators are the ones that administer deposit insurance. In the United States, ever since 1933, deposits in federally insured banks, which is essentially every commercial bank in the United States, are insured. The current deposit limit is $250,000, although as we'll discuss, that has some quirks to it. So in a nutshell, that's how banks are supposed to work. They take deposits, they make loans, they maintain a certain level of capital, they maintain a certain level of liquidity, they follow the banking regulations, and then, if necessary, they borrow from the Fed if they have no place else to borrow. That's in a very oversimplified manner. That's how the banking system is supposed to operate.
That's a course on Banks 101. Okay?
Right.
I view banks as basically risk managers. They're in the risk business, right?
Well, that's right.
Yeah.
And,
go ahead.
And there are different types. These banks today face lots of different types of risks. And the reason I picked these examples, I'm going to share my screen again, that we're talking about today is, in addition to the fact that they've all been in the news lately, they are also good examples of different types of risks that led to bank failures. Now, the first two we're going to talk about have been in the news quite a bit lately, Silicon Valley Bank and First Republic Bank. Now, these banks have a lot of differences, but they also have a lot of similarities, especially in terms of the types of risks that led to their failure. And let's take a look at some common banking risk. All banks have to manage these basic risks. So starting at the upper left quadrant, or upper right quadrant rather, you have credit risk. That's the easiest one to understand. That's the risk that if you lend money, people don't pay you back. And that is managed in many different ways. Then you have liquidity risk, which is basically that you have different types of assets, and there's a risk that you cannot convert one type of asset into another type as fast as you need the other type. And the classic example of this is when depositors come for their money and the money is invested in either assets that can't be sold quickly or assets that can only be sold at a big loss, and then the bank runs out of money. And that's basically what happened to Silicon Valley Bank. So that's liquidity risk. Then you have market risk. Market risk is the risk that your assets or your products will, as a result of changes in the market, be worth more or less than you thought they were. And this is what happened to Silicon Valley Bank and to First Republic. They got caught in a big change in the value of their assets due to the rise in interest rates. And because of that, they ended up with assets worth much less than they thought they would be worth. And that caused them to lose essentially all of their equity, which caused depositors to lose confidence, which caused them to have to fail. So that's the risk that hit Silicon Valley Bank and First Republic, and we'll talk a little bit more about that in a minute. And the last risk, and this is the risk that I've really spent most of my career on, is operational risk. And that's the risk basically that people will make mistakes. Either your processes will go bad, or people will defraud you, or you'll get hit with class action lawsuits or actions by regulators as a result of violating various regulations and laws. And as a result of that, you lose money. And in some cases, operational risk can be existential risk, because the risk can be so great that it affects the reputation of the bank, what's called reputational risk. And that's really what, in the end, brings down most banks. What the proximate cause of most bank failures is a loss of confidence in the bank. The bank may have various problems managing various risks, but in the end, it gets to the point that the depositors in the stock market conclude that the bank is not capable of managing their risks. They start withdrawing money, they start to lose confidence, and that's what brings the bank down.
Well, Fred, there's the Basel II Accords, right? Basically, it was an attempt to standardize operational risk management with banks, not only in the United States, but throughout the world.
Yes. If you've ever been to Basel, which is a very nice town.
Basel, Switzerland, yeah.
Switzerland, it's famous for two things: chemical plants and banks. And out of Basel came a conference when, and what you're referring to is a conference and then a series of proclamations that came out of that conference. And the reason that happened was, as banks became much, much larger and started to operate in multiple different countries, there was a concern that banks would simply incorporate in the country that had the loosest banking regulations, and that therefore there would be, the other countries would lose the ability to regulate them properly, and that would in turn affect the stability of banks in other countries. So Basel is basically an agreement by bank regulators to impose similar capital standards in all the countries to which are members of it, which are essentially all the large Western countries.
But it also imposed, though, on the banks a checklist of what to do so that they could be basically creditworthy from an operational risk point of view. Right.
Right.
What practices have been in place?
Right. Traditionally, the way banks decided how much capital to hold is that they would look at how risky their loans were. They would look at what they thought the interest rates would do. And based on that, they'd come up with an amount of capital to hold. Traditionally, banks never held any capital against operational risk. They just didn't do it. The big change in Basel, as you pointed out, was that Basel came up with standards that the banks were supposed to comply with in managing operational risk, and required banks to hold capital against operational risk. The idea being that if there was some serious existential event, that the banks would be more likely to handle it. Now, that has met with some success, but as we've seen, because of the repeated rescues that have had to occur in different countries, and we're going to look at one in Switzerland later on, it's still not a guarantee that banks will manage risk correctly.
Well, that is a problem. No, go ahead, Fred, but that is a big problem, right? Because you walk into the bank and you see it's a building, it's a big building, and these people must have money, but you don't know what's going on behind the spreadsheet, right?
Yes. Well, of course, as Jesse James famously said when they asked him why he robbed banks, he said that's where the money is.
Yes, exactly.
Operational risk in the old days was, you could think about those old Westerns where the bad guy comes up and tosses a stick of dynamite into the bank and then throws a rope around the safe and takes off with the safe. That was the most basic type of operational risk. Today, it's much more likely to be in the form of something like a cyber attack, or a vendor that doesn't do what he's supposed to do, or a class action lawsuit. But banks have developed very sophisticated ways to manage those things by trying to identify in advance the likely risks and taking precautions against them.
Well, Fred, would you consider, though, underwriting by bank officials to be an operational risk or a credit risk?
Well, underwriting is what's called a mitigant. In other words, a way to guard against credit risk. You underwrite a loan because you try to predict the likelihood that the borrower is going to default. And so the underwriter will go through a process by which he or she makes a judgment about the borrower's credit. Today, most consumer loan underwriting is done by computers, is automated. But for commercial loans, there's still a very complicated process where underwriters will go through and look at every aspect of the borrower's business and make decisions on on their credit worthiness. And then they'll give them a rating. And then depending on the rating, you can have a 1. The only thing that's a 1 is like a treasury bond, because there's no risk of default. But the risk of default will go down 2, 3, 4, 5, 6. And as the risk of default increases, the bank is required to hold more capital against that loan. And so the bank is making an assumption that every loan has some probability of default. What they're trying to do is reduce that probability as much as they can.
Well, Fred, you've mentioned banks that have failed in the United States, and Puerto Rico is the United States. Western Bank, Eurobank, and Doral Bank are all banks that went under. I happen to have read the pleadings when the FDIC took over those banks, and the banks primarily fell, I think, because of the underwriting issues.
Yeah, because of bad loans. Yeah. I mean, for example, the problems of the great financial crisis, when we had the largest bank failure in U.S. history, Washington Mutual, and we had some other near failures like Bear Stearns, and then we had a bankruptcy of a very large non-bank financial institution, Lehman Brothers. Those were all issues of credit risk, where the banks miscalculated the risk that was being posed by the investments. In many cases, it was subprime mortgages, but other things too, and made assumptions about the creditworthiness of those borrowers that proved to be incorrect. And that occurred on such a massive scale that it led to the great financial crisis, which is one of the reasons, by the way, when people talk about what's going on now, that the likelihood of a large systemic crisis today is much smaller than it was at that time, because virtually every bank held some sort of indebtedness related to subprime mortgages. The banks that have failed recently have unique characteristics that make them different, certainly from the very largest banks, but also from a lot of other banks.
Go ahead, Fred. Go ahead.
I was going to say, let's talk a little more about Silicon Valley and First Republic, because they shared certain characteristics that are worth talking about. One is they had a lot of relatively wealthy, sophisticated customers. That's very different than certainly the largest banks, and different than most banks. And number two, they had very different philosophies than most banks about what they did with their deposits. Most banks would take the deposits and lend them out to a rather diversified loan portfolio. Which means two things. One is if you had a crash in a particular industry, like, the steel, for example. If you had all your loans with the steel industry, that would be a bad thing. So the idea is you're supposed to diversify your loan portfolio across multiple industries. the second thing the difference there is that both these banks were very heavily weighted toward Silicon Valley, especially Silicon Valley Bank, obviously, but First Republic too, toward tech and venture capital related investments in California. And when interest rates went up last year, two things happened. One, the stock of many of those companies went down, and their prospects for an initial public offering going public went down because the market wasn't as interested in growth stocks. Suddenly didn't look so great when the growth stocks suddenly didn't look so great when the interest rates were 5% instead of essentially zero. And the other thing that happened was that these companies, which had been putting billions of dollars in deposits into these banks that they had received from venture capitalists, weren't getting the money anymore. So all of a sudden, instead of being on the receiving end of these deposits, both these banks started to see an outflow of deposits. And so those are market conditions that contributed to their failure. But what really caused the big problem was the impact of interest rates on these banks' investment portfolios.
But explain what that means when you say the impact of the interest rates. The high interest rates caused the devaluation of their assets?
Yes, not the loans, because the vast majority of loans today are made on a variable rate basis. So as anybody who has a credit card knows, if interest rates go up, the interest rate on your credit card goes up. It's the same thing with just about any bank loan. So actually, rising interest rates are good for banks that have a lot of variable rate loans because they'll have more income. But these banks both held a lot of, and especially Silicon Valley, had a lot of government bonds for two reasons. First of all, the regulators like government bonds. They want banks to put money in government bonds because they're safe. They'll have capital. But the other reason was that Silicon Valley Bank made a relatively low number of loans relative to the deposits they had on hand because their depositors were companies that were funded by venture capitalists. The venture capitalists were literally shoveling money at them. They didn't need the loans. And so because there was less demand for loans, they put more money in bonds than most banks. They also put money in long-term bonds. And the problem with long-term bonds is that if you can hold them till maturity, that's fine. You'll get the interest every month and you'll get paid off. But if you have to sell them in a rising interest rate environment, you have trouble. And this chart gives you an example of that. As bond yields go up, you can see the price of the bond goes down. So every time you read in the papers about the Treasury yields increasing, that meant that the prices of those bonds, if they were going to be sold, were going down. And not only did they go down last year, but last year was a historically bad year for the bond market. If we look at this, this is a graph of long.
Yeah, you want to share the screen, Fred? Go ahead and share the screen.
Okay. Somehow, hold on just a second. Somehow I got dropped out of the screen sharing.
So, Fred, while you're getting that up, can you tell us the difference between 2008 and now as to, banks were going to go out of business, and now they're going out of, they're being taken over for various reasons. Okay.
Well, there are several big differences. The biggest difference is that even though these banks are fairly large, Silicon Valley and First Republic were just under 250 billion in assets. And by the way, that's not a coincidence that they were just under 250 billion. We'll talk about that in a minute. But since the time of the financial crisis, banking in this country has become much more concentrated. For example, JP Morgan is over 10 times the size of Silicon Valley Bank. And the other big four banks are at least 4 or 5 times as big as it. So banking is much more concentrated than it used to be. And those big banks do not have anything like the credit or investment profiles of the of these other banks. So the chances of a widespread bank failures that would affect the integrity of the system is very low. The other reason, as I said before, is these banks have unique issues, primarily relating to their mix of business. And big banks tend to have very diverse portfolios, so they're not subject to the same types of stresses that the smaller banks are. Getting back to my chart here, if you look, this is a chart of the returns you would have made if you were long in U.S. government bonds. In other words, if you bought the bonds in every year since 1920. And as you can see, there were some bad years, but last year was the worst year ever, including the Great Depression. So anybody that was invested in long-term bonds last year, if they sold the bonds, lost a lot of money. Now that's a big if, because most banks buy these bonds figuring that they will hold them to maturity. And as a result of that, they do not have to count the losses that they are incurring on the bonds against their capital. I said a minute ago that it's no coincidence that that Silicon Valley and First Republic were just below $250 billion. That is a regulatory threshold, and below $250 billion, the banks are subject to much less stringent supervision than banks above $250 billion. So they intentionally tried to stay below that threshold. Had they been above that threshold, they would have been subject to a lot of other scrutiny by the regulators, which might have solved, have caught the problem here.
So did they stay under that threshold on purpose?
Yes, they did. Because
to avoid additional regulation.
Yes. And what happened was, it was sort of the worst of both worlds. Let me get out of screen sharing here, because Silicon Valley especially, but also First Republic, grew very rapidly. And they blew past, there's another regulatory threshold at $100 billion, at which banks are subject to even less scrutiny. And what happened to Silicon Valley was they blew past that very quickly. And the Fed, which just issued this post-mortem on their regulation and the mistakes they made in supervising Valley, said that led to two things. First, the risk management structure that the bank had in place was simply not adequate to keep track of what was going on because it was expanding too fast. And the other thing that happened was the Fed did not put the enhanced risk structure in place, enhanced supervision structure, in place quickly enough. It essentially wasn't paying close enough attention to get to the point where it could effectively get Silicon Valley to do what it should have done to avoid the crisis. Now,
so it would be the Feds that dropped the ball, pretty much.
Well, it was the banks in the first, of course, it was bank management that dropped the ball in the first instance. But yes, then it was the regulator that failed to supervise. See, because what happened here was Silicon Valley looked at the profile of their investments and made a critical error in judgment. They decided that the big risk that they were taking was not that interest rates were going to go up. It was that interest rates would start going down. And if interest rates started going down, their net income would start to decrease because the income on their loans would start to decrease. So they changed their portfolio around to actually make it more sensitive to a crash in interest rates, to an increase in interest rates, and it already was. They just made a fundamental error. The other thing they did, and the regulator is somewhat culpable in this too, is that they just assumed that people would not take their money out of the bank. They did not test for an all-out panic, which is what happened here. They tested for a certain,
in It's a Wonderful Life. You know,
yes, well, that's the classic
money out of Bailey Savings and Loan, right?
Yeah, and we have another slide here to illustrate that actually. The classic banking panic is people lined up out front. This is Northern Rock, which is one of the early casualties of the financial crisis in 2008 that the British government ended up having to take over. And this is actually a line outside the bank the day it failed. Now, there may or may not have been lines outside Silicon Valley Bank, but the reason that this, what happened there is so significant is that they actually had what effectively was a cyber run on the bank. Again, because their customers were so concentrated in one industry, these high-tech industries, and they all talked to each other, that they started chattering on Twitter and started getting nervous. And ironically, what set them all off was the bank finally, too late, realized that these losses on their bonds were going to drive their capital down too low and that they needed more capital. So they went to Goldman Sachs and said, could you please help us raise a couple more billion in capital? And Goldman Sachs said, oh, sure, we'll do that. And oh, by the way, we'll also sell some of these bonds for you and make some money doing that. And Goldman and the bank then announced that they're going to do that, thinking that that would be good news because it would be more capital for the bank. Well, it had just the opposite effect because nobody realized that the bank was in such bad shape as it was. And when they heard that they were going to have to raise capital, people panicked and started taking money out of the bank.
It's a matter of perception, Fred, isn't it? I mean, it's strictly perception.
Well, like I said before, the main reason banks fail is that people lose confidence in them. And we can talk about why people lose confidence. Mm-hmm. In this case, was a combination of market conditions, errors by management, mm-hmm. and perhaps too lax a regulator. But in the end, what sends the bank down the tubes is the depositors lose confidence. And that's why bank failures can be contagious. If you look at First Republic, the bank we talked about earlier, they had slightly different problems. They had interest rate problems too, but one of the big mistakes they made was they decided, see, one of the ways that banks keep deposits is they establish relationships. If you open it, I think everybody's had this experience. If you open a deposit account in a bank, the bank will always say, hey, would you like to open a credit card? Do you need an auto loan?
Yeah. They want a lot of cross-selling.
Right. And they want to create what's called a sticky deposit. And a sticky deposit is a deposit is with a customer that is unlikely to move the deposit, mainly because the customer is not really paying attention. So if you're not sophisticated and if you're below the FDIC insurance limit, then the chances are, unless you get really bad news, you're not going to do anything about your bank.
Yeah, you have a loan, you have a credit card, you have a bank account, So it's really milking as much money as they can from each client / depositor, right?
Right.
And that's how you secure the depositor.
Yeah. And the other thing is, ironically, while it's relatively easy to withdraw your money from the bank today, it's kind of a pain in the butt to change banks. If you've ever tried to close all your accounts at one bank and set up all those accounts again at another bank, it's a lot of aggravation, right? Your paycheck is directly deposited into your account. You've probably mm-hmm. a mortgage that's being withdrawn from your account. You may have, credit cards that you have to cut up and get new cards. It's a lot of work. So there's a lot of
internet banking. Yeah, internet banking has made it more difficult for people to switch banks.
Right. There's a lot of friction involved in switching banks, and so that's what the banks count on. And what First Republic did, they had this kind of odd way of creating relationships. They decided it would be a good idea to go out and give a lot of very large below market mortgages to rich people. So, for example, one of the mortgages on their books is a 25-year mortgage to Mark Zuckerberg for something like $20 million at an interest rate of less than 1.5%. Now, for Mark Zuckerberg, that's a pretty good deal, but it's not a great deal for the bank. The bank did that because they could then say, hey, look, one of our clients is Mark Zuckerberg. That will, word will get out. Other people will want to bank where Mark Zuckerberg bank. And they did that for a lot of people. And so as a result, they ended up with this portfolio of mortgages, which first of all, they were too big to sell to Fannie Mae or Freddie Mac or the other federal agencies that buy mortgages. And secondly, they were well below market. So as long as the bank was holding them to maturity, they did not have to take a markup. But if they ever had to sell them, they would have had to take a huge bath. So they had these large unrealized losses.
But they were making that type of loan, hoping that Zuckerberg would bring in more business.
Exactly.
and you know, to have him not just for a loan, but he may say, I'm going to switch, because he could make or break a bank, right?
Well, of course. And they had many other people like that. And again, it's this phenomenon of your client base is concentrated in this narrow industry that everybody talks to each other. So when one person starts to lose confidence, it gets very contagious and people start withdrawing their money and people hear about the withdrawals. What did First Republic in was when they announced their earnings last week, people were expecting their deposits to be down by a certain amount, but it turned out the deposits had run off by twice that amount. And at that point, their stock started tanking and it became, and so then more people took out deposits and it just became a death spiral.
Well, Fred, if everyone, you know, you've got Bank of America, you've got Chase, you've got all these big banks. Let's say that everyone in the country said, I'm taking my money out of Bank of America. Would that cause Bank of America to crumble, or Chase Bank, or any of the huge banks?
Well, that would be a massive catastrophe because, first of all, we really haven't talked about this, but the Federal Deposit Insurance Corporation insures deposits through what's called the Deposit Insurance Fund. The Deposit Insurance Fund is a fund that is set up by contributions by banks. Banks pay premiums into it. It is set based on certain actuarial assumptions based on previous activity and previous failures. There has never been a failure remotely as large as Bank of America, or any large bank like that. So a bank failure like that would bankrupt the Deposit Insurance Fund and would require a massive appropriation of funds by Congress.
But that was close in 2008, which is why the banks had to be bailed out, right? I mean, not because the depositors were coming out, but because everything tanked.
Well, to be clear, and I just want to be clear about this because you brought up Bank of America. At no time was Bank of America close to going out of business. The concern was that there was this rolling series of failures, and that as one bank failed, people would lose confidence in another one, and another, and another, and another. Mm-hmm. So the Treasury Department decided that the only way to stop that was to create a program that would fund all banks, which was the TARP program.
Okay.
Which all heard of. But the important thing about TARP from the Treasury's point of view was that all the banks took TARP, including the banks who were doing fine, because otherwise it would have been seen as a stigma. People would have said, oh, well, that bank needs TARP, so therefore they must be in trouble. So let's go take our money out. It would have been counterproductive. So the only way it would have worked is for all the banks to accept. And it did work. It did work. The TARP essentially was the banks paid back TARP. The TARP program ended up losing money on some other things like the bankruptcy of General Motors. Mm-hmm. But in general, the banks paid back TARP, and there were no more big bank failures after TARP. But again, I want to be clear, we're nowhere near that today. We're talking about banks that have a much, much, much smaller piece of the banking system. For example, the Federal Reserve, as I think everybody knows, raised interest rates again this week. And the way they do that is they come out with what they call the Fed Open Market Committee. They come out with a statement. It comes out at 2:00. And they make this statement in which, among other things, they'd say what they're doing with interest rates. But they also say a bunch of other things. Now, one of the things they said in there is the American banking system is stable and sound. Now, that sounds like BS. But the reason that they say that is they have said that every quarter for many years. And if they were to say anything different, people would get really nervous. So they say that in order to ensure that people remain confident in the banking system. And frankly, the banking system is stable and sound. There are individual banks that have problems, and there may be more banks that fail, but the basic system is stable.
Fred, let's talk a little bit about Credit Suisse, because that's kind of a unique situation.
Yeah. So again, let me just share my screen briefly. Credit Suisse, first of all, is much bigger than the banks we're talking about here. When it went under, and actually it didn't go under, it was sold to another bank. When it finally met its end, it had about $600 billion in assets, which would make it about the sixth largest bank in the United States, but a big bank. Also a very old bank. Credit Suisse comes from the 19th century, and it's one of those banks that had it has a lot of history associated with it. And what happened to Credit Suisse is sort of the story of the Swiss banks in general, which is, I think we all remember the days when you could maintain a Swiss bank account. I never had one, Rudy, you probably did, and be sure that everything about it was secret and it would not be subject to legal process by anyone, including the government of the United States. So it was literally a way to hide money. And after a while, the other Western countries got fed up with the Swiss because too many people were using bank secrecy in Switzerland as a means of tax avoidance. And so they forced the Swiss to enter into a treaty that ended that. And so the Swiss now do accept legal process on banking customers from other countries. Well, when that happened, that really had a big impact on the big Swiss banks, because now they no longer, for these very rich clients, had this selling point that they could keep everything secret from everybody by opening a Swiss bank account, because they couldn't do that anymore. So
well, you mentioned tax avoidance. I would say it was more like tax evasion.
Well, I was trying
to be nice.
But that's right, yes. And so what happened was Credit Suisse found itself having to compete with other banks for these wealthy customers, and having to compete with them in a different way. And so they, as a result, got into a series of transactions in which they made big mistakes. The first one was an investigation actually by the U.S. Justice Department, which found that they had gotten their customers to invest in schemes for the purpose of tax evasion, and paying a multi-billion-dollar fine to the Justice Department for that. Then they financed this deal in Mozambique to finance a natural gas project in Mozambique that was an absolute disaster. Much of the money was stolen, and many of the projects that were supposed to occur never got built. So they had a big black eye from that. Then they were involved in another big transaction called Greensill. Some of our viewers may have heard of these transactions, which was supposed to be a very plain vanilla trade finance transaction where essentially you could finance your receivables through this entity. Well, it turned out there were no receivables. And so the collateral they thought they had didn't exist. And even worse, the notes that the customer Greensill had created that were supposedly backed by this collateral, Credit Suisse had turned them around and sold them to their own customers. They had sold their own customers these notes that turned out to be worthless.
Well, but then the Saudis were going to invest and change their minds, right?
Well, the Saudis actually did ultimately invest. I'll get to that in a minute. But there was one other transaction I feel compelled to mention because it's also been in the news lately. It was a transaction called Archegos, which was this scheme that this one family office in New York had to essentially corner the market on some pretty large stocks and bid up the price of the stock extremely high. And Credit Suisse entered into what's called a total return swap of Archegos, which, without getting into the details of it, is a way to get the benefit of ownership of stock without actually owning it. And that worked out fine until the stock started going down. Then all of a sudden, the perpetrator was on the hook for hundreds of $millions of collateral calls, and what a surprise he didn't have the collateral. So Credit Suisse took an enormous bath on that. So anyway, it's this series, one after the other, of disasters. And with each one, they get into more and more difficulty with their regulator. The president, they went through multiple CEOs. They did get an investment, as you point out, from the Saudi sovereign wealth fund, that the Saudis looking to diversify their investments beyond fossil fuels. But because of all these operational errors and these bad transactions, people started to lose confidence in the bank, same thing we're talking about, and started to move deposits. And Credit Suisse took steps to assure the community that in spite of all these losses, they had ample capital and they were going to raise more capital. And in the midst of this, the guy at the Saudi Sovereign Wealth Fund who was responsible for the investment was asked, well, would you consider, since Credit Suisse is trying to raise more capital, would you consider investing more in Credit Suisse? And he said, well, no, in light of what's happened with them, we're not investing any more money. Well, of course, that was the kiss of death. As soon as that happened, people started losing confidence, people started withdrawing funds, and it looked like the bank was headed for failure. Now, although the Swiss are known for banking, in fact, their banks are much smaller than the banks in the US, Britain, France, and Credit Suisse was one of the two largest banks in Switzerland. So an actual failure of Credit Suisse would have been a disaster for the Swiss government. So the regulator came in and forced them to merge with UBS, which is the other very large Swiss bank. Both banks have operations in the United States. And Credit Suisse's shareholders and their, I mentioned this earlier, their additional tier 1 capital bondholders, which is the type of subordinated bond, got wiped out. They got nothing. And so they ended up taking the losses. The Swiss government will also take some of the losses. But UBS essentially is being paid to take the company over. And it remains to be seen how well they'll do with it. But that's an example of a bank that collapsed because of a failure to manage operational risk. They failed to realize that they were engaging in transactions that were illegal, or if they did know about it, they went ahead and did it anyway, which is not a great idea. Or they just failed to execute properly. For example, on those last two examples I gave you, Greensill and Archegos, the bank should have taken steps to make sure that the collateral that they thought was there actually existed. Well, they never did that. One of the reasons was, in the case of Greensill, it was being promoted by some very prominent people in Britain, including the former Prime Minister, David Cameron. And so they just assumed, well, if he's behind it, it must be good. Well, it turned out it wasn't so. And similarly with Archegos, because other banks had similar arrangements with them, they figured that they must be okay because everybody else is doing it. What they didn't realize is that they were much more exposed to this transaction than anyone else. So when the bell rang and there was no collateral for the collateral calls, they took much bigger losses than anyone else.
Well, and it's amazing that, will anyone go to jail for what happened with Credit Suisse? I mean, it
remains to be seen. The rescue is very unpopular in Switzerland for two reasons. First, Credit Suisse is considered this apple pie and motherhood institution. The idea of it going away is, I don't know what the equivalent is of apple pie in Switzerland, but the idea of it going away really bothers some people, and thousands of jobs will be lost. So there's that, and there's also the sense that somebody ought to pay for this. So it could happen. I mean, famously, nobody went to jail as a result of the Great Financial Crisis, and that we could do a whole other podcast about that. But will anybody go to jail as a result of what happened at Silicon Valley and First Republic? Remains to be seen. One of the interesting facts, and I'm not suggesting anybody should be put in jail for this, but one of the interesting things that I read the other day is that the four big banks that have failed recently, Silicon Valley, First Republic, Signature, and I actually can't remember the name of Silvergate, which was a crypto-oriented bank. All of them had the same auditor, KPMG. And the CEO of Silicon Valley Bank is a former KPMG partner. So one thing that will definitely be raised is the extent of KPMG's oversight over these banks.
Well, these audits are required. I mean,
well, they're selling stock on a public exchange. So yes, they have to.
Exactly. So they have to be audited. Now, I mean, I am not accusing anybody of anything, but one would think, I'll ask it in the form of a question, that an audit may have spotted those types of issues, or should have.
Yeah, this would be a good time for us to talk about risk management. So with risk management, you talk about the three lines of defense, the three that are supposed to be aware of risk and take steps to mitigate. The first line of defense is the business people, the people who are the operations people who are on the ground, are supposed to recognize what's going on. The second line of defense is legal and compliance. People are supposed to oversee what's happening, make sure that the business people are complying with the law, look for red flags. The third line of defense is audit. They're the ones that are supposed to come in and make sure that that everybody else is obeying the rules. And what happened here is that all three lines of defense failed.
Well, they did, but I've seen, getting back to what I've seen in Puerto Rico, mean, with Western Bank, for example, they had a rating of 1 from IDT Publishing. Okay. And, you know, if you're a bank who's solvent, you have a rating of 165. Okay. And when I read the pleadings, they were making loans they shouldn't have made. They were giving extensions, things like that, which was a total lack of oversight.
Well, one of the problems is that regulators and auditors cannot possibly look at every single loan. And so all they can do is look at a sampling of loans and make assumptions about what is or isn't being done. In the end, that's why you have 3 lines of defense, because you hope that with the 3 lines, somebody will catch it. But in the end, the auditors, it's just not feasible for the auditors to look at every loan. And so that's the problem. I put up this
the fraud, well, Fred, the fraud is hard to catch too, because fraudsters could be very creative.
Yeah, and that's another common misconception, that audits are designed to catch fraud. Audits, if senior management is involved in fraud, it's almost impossible for an audit to catch it. There are too many places for them to hide. I put up this slide because this describes how a good risk management program is supposed to work. You identify the risk. In other words, what are the risky practices? You assess it. Basically, how big a risk is it? Is this something we should be worried about? And you prioritize. Analyzing is basically the same thing as assessment. And then you mitigate the risk. And the 3 things at the bottom are all risk mitigants. One is simply reducing risk. And, an obvious way to do that is stop engaging in the risky practice, but there are some practices that are inherently risky. Another one is internal controls, put in more layers of approval, put in computerized assessments that will kick out problems automatically. And then the third way is transfer of risk. And the most common way of transferring risk is insurance. That's a risk mitigant, but also banks will make loans and then sell participations in loans. They'll make a loan and sell 80% of it to somebody else. So if the loan goes bad, they're only on the hook for 20%. That's how a risk management program should work.
Right. But Fred, let me ask you though something. When a bank, why don't you put that slide back up a second? When a bank sells its portfolio, its securitization portfolio, they're not necessarily eliminating the risk when they do that, because there's recourse back with those loans. Isn't that the case?
There is recourse, but only generally you can sell with or without recourse, but most loan sales are made without recourse unless there is a violation of a rep or warranty that the seller gave when they sold the loan. And this was a huge problem in the financial crisis, that many of these mortgage securitizations were sold on the basis that the seller represented that these people had certain credit scores, that the loans had a loan-to-value ratio, that the people are occupying their houses, which in many cases turned out to be false. And that led to a lot of people trying to go back against the sellers of the mortgages.
Well, and there was stated income where they got no verification, but the banks charged a higher interest rate. So, you're making $100,000 a year, you get a loan as if you're making $200,000.
Yes,
but the bank charges you a higher rate because, well, we don't have to check your references. And then you get the adjustable loan where your mortgage is $1,000, now it's $2,500 because the interest went up. And because you got a loan based on income that really doesn't exist, you can't afford the loan. It's just a crazy, vicious circle.
Yeah, and again, to try to relate that to today, that is an example of a single asset class, subprime mortgages, that exploded through securitization, that banks took on and investors took on an enormous amount of risk, not realizing that they were, because through financial engineering, many of these mortgage-backed securities were rated AAA, when in fact what was there was far from AAA. And then by the time people realized that the collateral was not worth what it was represented to be, it was too late. Today, we have nothing like that. You do not have a single asset class that is spread across all banks that is likely to go bad. What you have are relatively unique situations in these individual banks.
So that's unlikely to happen again. But I think that part of that was pretty much criminal. when you sell a portfolio representing this AAA investment, it's really C or D grade investment. I mean, that's a material misrepresentation.
Well, it's a little more complicated than that, because the reason those tranches or slices or portions of the mortgage-backed securities were rated AAA was because a rating agency rated them AAA. And the rating agency made a judgment based on the information it had about the loans. And did some of that information prove to be incorrect? Yes. Were they fraudulently misled? Well, that's something that we'll probably never.
Well, that's something that a jury would have to decide in a criminal case. But I think that people were making so much money with these mortgage-backed securities that nobody questioned it.
Well, they were originated to what was euphemistically referred to as Wall Street standards, meaning that essentially, if the borrower had a pulse, they would buy the loan. Because there was just basically unlimited demand for this stuff until it all fell apart. But again, I want to stress that's the great financial crisis. That's not what we're talking about today.
No, I get it. It's something different, but it's good to compare. Fred, No, go ahead. We have a question. Fred, do you know the reason why Citigroup is about to sell its business in Mexico?
Well, yes, generally. Citigroup for years relied extensively on its international operations. And for the last few years, it has been gradually paring them down. And Mexico, I believe, is one of the last ones to go, in part because they have a very large business in Mexico. But management has determined that it's just not profitable to compete against the other banks in these other countries, and that they can't adequately manage the risk. So it's part of a general strategy by Citi to get out of their banking operation in most other countries.
Okay. So Fred, the takeaways I want to leave with our listeners is, first, when in terms of effective risk management for a bank, they have to first identify the risk, right? Assess and analyze. They reduce the risk by inserting certain controls, and then they transfer out whatever risk they can.
Right. And one thing that's not on here that's really important is that you need communication from the bottom up so that management and the board know what the risks are, and the board and management has to buy into the risk management process. I mean, what we talked about with Silicon Valley Bank, for example, with the crash and the size and the value of their bond portfolio, management knew about that. Management made a conscious decision not to do anything about it because they thought it would reduce their net income. And that's a short-term decision that led to the collapse of the bank. So management you not only has to have the risk management process, but the board and senior management have to be willing to buy into it.
Well, on that note, we'll close on risk management with banks. Fred, it was a really interesting topic because nobody ever really starts to think about banks, until recently. You see these banks that are being taken over, and people are going to wonder if there's a scare again. What should I do? Is my money safe? And we haven't even touched the FDIC. If the bank goes under, and how is your money protected?
Well, I will say this, that the FDIC limit is $250,000 per person per account. So, for example, if you and your spouse have a joint account, you actually have $500,000 in protection. So, unless you have more than $500,000 in protection, if you're somebody like Rudy, you don't have to you don't have to be too concerned. And frankly, we're headed in this country, in my opinion, to a scenario where the government is going to guarantee all deposits. It may be a rocky road, but I think that's where we're headed.
Well, Fred, we're going to sign off now with our LinkedIn audience. Thank you so much. If Fred is now a private consultant, he's available as an expert witness. Even if you just want to know about banks, Fred, how can people reach you?
Well, I'm on LinkedIn, or you can email me at fred@egler.com. That's EGLER.
Easy enough. Thank you very much, Fred. I'm going to stop now with LinkedIn Live. And by the way, those of you, please subscribe to my channel. Please like me on LinkedIn.
Yes, I can attest. Rudy's channel is very interesting and entertaining, and I appreciate the opportunity tonight.
Thank you. Now, Fred, what I normally like to do, and I'm going to. Don't forget, you are watching Conversations with Rudy Rivera.